Renting versus buying, it's the internet's favorite debate. And today we'll be diving deep in this video. Some people swear that renting is smarter because you can invest the difference. Others swear that buying is the only way you'll ever get ahead. But in this video, I'm not here to pick a side. I'm here to show you the actual numbers and calculations behind it. We'll run an example in Sydney, Australia using real numbers. Then we'll check in and do a scoreboard at 5 years, 10 years, 20 years, 30 years, and 40 years. And at the end of this video, we'll give you some rules to help you make up your mind which one's right for you. Because the goal at the end of the day isn't just to make sure that the numbers make sense to you in a spreadsheet, but actually work for your real life as well. And if you're new here, hi, I'm Queenie and I'm a personal finance creator, and I have a license to give general financial advice. So keep in mind that anything that we discuss in this video is general advice only and not personal financial advice. You can read my full financial services guide in the description. So sit back, relax, grab a drink of your choice. Today I'm drinking hibiscus flower tea and let's get into it. So let's set up our calculator and compare renting versus buying. Most people I've noticed compare rent to the mortgage payment. And in my opinion, that's why everyone starts arguing. But it's not the full picture because a mortgage payment has two parts. First, you have the interest, which is basically money gone, similar to rent because it goes straight to the bank. The next part is the principal, and this is money that you keep because it essentially turns into equity. So in my opinion, the fair comparison is the renting costs versus the owning unrecoverable costs. So the unrecoverable costs of a mortgage include things like the mortgage interest, plus also running costs like rates, insurance, strata if you're purchasing a unit, and also maintenance. There are also upfront costs when you're buying a property, and this includes things like stamp duty or transfer duty, legal fees, reports, and moving costs. So that's basically the setup. Let's start plugging in the numbers. And if you're looking to buy your first home, or you just want to get control of your cash flow and make sure your money is going to the right places, I highly recommend checking out a budgeting or spending tracker app like Billroo. This is the app that I've been building with my team and I'm so proud of it. I literally use it every single day to see where my money is going, and it's helped me be a lot more mindful about where my money is going and my finances for the future. So if you would like to check it out for yourself, I've got a link in the description below for a 14-day free trial, or you can use this QR code up here. So now let's get into the calculations of renting versus buying. So first, buying. In this example, we're purchasing a unit in Sydney. The purchase price is $840,422. We've bought it with a 20% deposit of $168,084, and our loan is for $672,338. So here are the upfront costs associated with owning a property. You've got the stamp duty or transfer duty at $33,000. Side note, first home buyers may be able to qualify for a stamp duty exemption. This stamp duty exemption fully applies for properties under $800,000, but for homes valued at $800,000 to $1 million, there may be a discount. But in this example, I'm just using the stamp duty cost. You also might get a strata report for around $200, conveyancing and legal fees for $1,500, loan application fees for $600, and moving costs for around $3,700. That brings your total upfront cost to $39,000. So the total cost to move into your home on day one are $207,084. And here are the loan details. You have a loan amount of $672,000. The interest rate is at 5.5% per year. The loan term is 30 years, and the monthly repayment is $3,815. So in month one, you pay interest of $3,080, and this is money gone, similar to rent, but you also pay back $735 to your principal, which is money that you get to keep because it's equity. So now we know the mortgage breakdown. Here's what the annual running costs of owning this property. Strata fees would be around $400 monthly, council rates at $120 monthly, water rates at $60 a month, insurance at $50 a month, maintenance at $60 a month. So the monthly running cost of this property would be $690, and the annual running cost would be $8,280, and this is without the mortgage. So in order to buy, in the first year you pay your mortgage payments, which would come out at $45,000 over a year. year. The running cost would be $8,280, and that includes things like the strata, council, water, insurance, and maintenance costs. You also had upfront costs in order to buy the property, which came in at $39,000. So the total spend for year one would be $93,060. Now let's have a look at where you'd stand over time. After year one, assuming that your property rises by 4% per year, it would be worth approximately $874,000. The loan balance would be $663,000, and your equity would sit at $210,000. But as discussed, you would have paid around $93,000 in order to make this purchase. So your total net worth after year one would be $210,000. So we take your asset value and we minus the debt. After 5 years, your equity would sit at around $395,000. After 10 years, it would sit at around $662,000. After 20 years, it would sit at around $1.4 million. And after 30 years, the equity would sit at $2.5 million. But there are a lot of assumptions that we made in order to get to these numbers. First, we assumed that the property would grow by around 4% annually, which is pretty conservative for Sydney long term. We also assumed that the interest rate would stay at 5.5% every single year consistently, which is also unlikely in reality. We assumed that there would be a 1% running cost on the property, and this also increases as the value of the property grows. We also assumed that you stay in the property for the full 30-year period. We assumed that there are no renovations or major repairs. And finally, we also assumed that there's no refinancing or rate changes. So any change in any one of these assumptions would change the outcome dramatically. So now we know the numbers when it comes to buying. Let's compare that to renting instead. So here's the renting starting position. So we're going to assume that instead of buying the property on day one, you're going to use all of that capital and invest in the stock market instead. So if you add up the deposit, the upfront costs, and minus the rental bond, which is something that you would need to pay if you are renting, this gives us a total of $204,000 to invest straight into the market on day one. Your rent starts at $750 a week, which adds up to $3,250 a month. This would be the rent that is charged for pretty much the same property that you were going to buy, but instead you're going to rent it instead. The rent increases by 4% per year, which is Sydney's average, and the rental bond is $3,000, which is 4 weeks rent. It is refundable, but we didn't include this in the calculations, just to make things simple. So your total lump sum investment is $204,000, and you choose to invest this in ETFs. Your investment return is 8% per year, and you also make monthly contributions to this investment portfolio. You basically invest the difference between what a buyer pays and what you pay in rent. In this case, the difference that you have to invest is $1,255 a month. But this difference changes over time because rent increases at 4% per year. The buyer's running costs increase as the property value grows as well, but the buyer's mortgage repayment stays the same. Now let's look at where you stand over time. After the first year, your total net worth is $236,000. The money that you've paid over the year is $39,000 in rent. Your investment breakdown is as follows. You made an initial investment of $204,000. This has grown to $220,000 with an 8% return. And you also make monthly contributions at $1,255 per month, which equals $15,060 over a year. The growth on your contributions for that year is $602. So your total portfolio is worth $236,000. So this is what your monthly cash flow looks like. You spend $3,250 on rent, your investment contribution is $1,255, so the total monthly commitment is $4,005, which is the same as the buyer, when you include all of their monthly running costs as well. So in comparison to buying your own home, you're actually ahead by $25,000. And now let's have a look over 5 years. After 5 years, your net worth has grown to $375,000. And at this stage, it's actually flipped and the buyer has now come out ahead in their net worth. The difference between the buy and rent net worth is around $19,000. After 10 years, the buyer is still ahead and the net worth difference is $79,000. After 20 years, the buyer is still ahead and the net worth difference is $166,000. But here's where it gets interesting. At year 28, rent actually comes out ahead. The net worth of the renter is around $35,000 more than the buyer, and then after 30 years, the renter actually comes out ahead, and their net worth is $160,000 ahead of the buyer. And even after 40 years, the renter is still ahead of the buyer by about $478,000. But here are some really important assumptions that we've made in order to get to these numbers. The first one is that we haven't calculated any tax at all when it comes to investment returns. In Australia, if you own a place to live in and you sell your property that you have lived in, you actually don't need to pay any capital gains tax on the gain that you've made on your property, so long as you live in that property and you are an owner-occupier. Whereas when you're investing in the stock market, you actually do need to pay capital gains tax on your investments when you sell them. But if you hold on to them for longer than a year, you get a 50% capital gains tax discount. We didn't calculate tax on these numbers because it started to get a bit messy, to be honest, and we wanted to keep things simple. So that's one thing that hasn't been factored into these calculations and something to keep in mind. The next thing that we assumed in the renter assumptions is that there's an 8% annual return on their investments. We've also assumed that the renter has perfect discipline and they invest the difference every single month for 30 years. We've assumed that their rent increases by 4% per year, and they invest the full lump sum that they would have paid for the deposit into the stock market from day one. We also assumed that there are no rental market disruptions or forced moves. We assumed that there were no emergency withdrawals from their investment portfolio. And also just keep in mind that investment returns in the stock market doesn't give an average return of 8% per year perfectly. Some years it could be a lot more and some years it could be a lot less, but we've just used an average return of 8% per year to keep things simple. And now for the buyer assumptions. We've assumed an annual property growth of 4% per year. We've assumed that the interest rate stays at a constant 5.5% per year. We've also assumed a 1% running cost on the property, which increases with the property value. We've also assumed that this person stays in their property for 30 years or more. And we've also assumed that there are no repairs or renovations needed during that period. So let's actually dive deep into these numbers to figure out why some years buying might come ahead and some years why renting might come ahead. And also something really important that we haven't factored into these numbers that I think is a major drawback, in my opinion, for the renting option, especially after 30 or 40 years. So first, when it comes to year 1 to 4, renting leads because there are lower upfront costs. Basically, the renter avoids having to pay $39,000 in upfront costs to buy their property. They also have $104,000 invested immediately that is returning 8% per year, and their monthly costs of rent are lower than the buyer. But when it comes to years 5 to 27, buying takes over, and this is because of the power of leverage. The buyer essentially controls an $840,000 asset, and they've only invested $207,000. They also get a 4% growth on $840,000 worth of property, and while the renter does get a higher return of 8%, it's only on $204,000. The buyer's returns are essentially amplified because they're controlling a much larger asset, and this is why property builds wealth faster in the middle years. But then around year 28 to 30, the renter catches back up, and this is because the renter now has a massive portfolio of $2.3 million, and an 8% return on $2.3 million is $184,000 a year. The buyer has a 4% return on a $2.5 million property, which is around $100,000 a year. So the higher return rate of 8% versus 4% eventually wins when the portfolio gets big enough. And this is because compound interest is exponential and it really does accelerate over time. But now let's talk about something that we haven't spoken about yet, and that's the rent escalation trap and what it could be like renting while you're not working at all. Obviously, the renter is renting for years, and this rent increases at about 4% per year. This means that the rent has increased a lot by year 30. You'll see that the rent is really expensive while the mortgage stays the same. So year 1 versus year 30 or 40 for the renter is actually very, very different. In year 1, the renter pays $3,250 a month. Year 10, it's $4,626 a month. Year 20, it's $6,847 a month. By year 30, the rent is $10,136 a month. And by year 40, it's $15,006 a month. That's a massive increase from year 1. But you might be thinking, yes, Queenie, the rent is a lot more expensive, but the renter also has a really massive investment portfolio that they can use to pay for the rent. But here's where things get a little bit tricky: retirement. At year 40, which we're assuming is the renter's retirement age, the renter still needs to pay $15,006 a month in rent. And let's say, for example, this renter has a really long life and they end up living from ages 60 to 90. That's another 30 years that they need to keep on paying in rent, which is increasing at 4% per year. Over that 30-year retirement, rent alone costs $9.7 million, but the renter only has $5.9 million in their portfolio. So if they're not working at all, this person essentially runs out of money by age 75 to 80, whereas the buyer, when they reach age 60 and their mortgage is completely paid off, they don't need to pay any more money in mortgage costs. The only costs that they need to pay are the running costs to keep on going with their home. So when you compare the renter's costs to the buyer's costs, the buyer actually pays around $1.8 million in housing for this 30-year period instead of $9.7 million. This means that the buyer's portfolio still stays intact and they get to give something to their kids when they pass away. So this is where it gets really dark for renters, and something that we should be factoring in when we are looking at these numbers. Life doesn't just end when we get to year 30 or 40. It could keep on going on for a really long time, and that's when buying really comes out ahead. There's also another really big elephant in the room, and that's that these numbers assume that the renter invests every single month for 30 years. In reality, most people don't invest every single month for 30 years, especially when it's optional. Life happens, emergencies pop up, holidays, lifestyle inflation, and temptation pops up. And studies actually show that homeowners accumulate 3 to 4 times more wealth than renters, because buying essentially means forced savings. The bank makes you pay. But when you're renting and choosing to invest the difference, it requires a lot of discipline, which the average person generally just doesn't have. So now let's talk about the real reason you clicked on this video. Does buying make more sense or renting? And it's not a perfect answer, there are different pros and cons for both. Here's when renting might make sense. If you need flexibility, like if you might be changing jobs and you just want lifestyle changes. If you're only planning to stay in the property from 1 to 5 years. If you have amazing discipline and you want to keep on investing consistently. If you can achieve 8% per year returns consistently. And here's when buying might make sense. If you want to stay in a property for 7 years or more. If you value stability and forced savings. If you want to lock in housing costs. If you believe in long-term property growth. If you want housing security in retirement. And finally, if you prefer tangible assets like owning a property. If you're looking to buy your first home, or you're just looking to rent smarter and make sure that your money is going exactly where you need it to go, I highly recommend checking out a spending app or a budget tracker. I've been building Bilru over the past couple of years with my team, and I honestly use it every single day to manage my money and see where it's all going. It's been such a game changer for my finances, and I feel like I finally have control over my money because I know exactly where each dollar is going, and it helps me make smarter decisions for the future. So if you would like to check it out for yourself, you can scan this QR code up here, and I've also got a link in the description to a 14-day free trial. So here's exactly where I sit on the renting versus buying debate. So I've been in both positions. I've been a renter that was investing, and I've also been a homeowner that's also investing as well. And in my opinion, buying definitely wins for me, especially because I have this personal situation that was really stressful that happened to me a couple of years ago. For context, Pablo and I had bought a 2-bedroom apartment in Sydney, and we were renting that out because we decided to go on a 3-month trip around the world. And while we were gone, we wanted to earn some money while we were away, so we ended up renting out our apartment. So when we came back to Sydney, we needed a new place to live, so we decided to rent another apartment in Sydney. It all went pretty well for the first year, although there were a lot more renters than buyers at the time, so it was a bit more challenging to actually find a place to rent. But once we actually found a place to rent, it was pretty good for the first year. But that all changed after the first year. We were renting an apartment for $690 in Sydney, just a 1-bedroom apartment, and after the first year they wanted to raise our rent by $50 a week, so it was essentially like a 7% increase in just 1 year, which is quite a lot, especially for just a 1-bedroom apartment. I was also pregnant at the time, and we really just didn't want to lock in another 12-month lease because I was pregnant and we were thinking of finding somewhere else to live and maybe buying another property. We tried to negotiate the rent with the real estate agent. They declined. So then we agreed to just pay the rent, but we would just pay month to month. The real estate agent was really pushy and they wanted us to sign up for another 12-month contract. And when we said no, they were like, okay, what about a 6-month contract? And we still said no because I'm pregnant. We're thinking of moving somewhere else. It's only a 1-bedroom apartment. We didn't really want to stay there long term, but we still agreed to pay the rent that they were asking for. Anyway, that's when the real estate agent honestly surprised us a lot, and they sent us an eviction notice, and we basically had to leave the apartment within 4 weeks' notice. It was super stressful at the time because it was really difficult to find somewhere to live in just 4 weeks, and also I was pregnant at the time, so it was just a very stressful situation. Thankfully, we still had the apartment that we bought initially, and I felt bad because we also had to kick our tenants out, which just was really awful. And yeah, that's basically what happened. Thankfully now we did end up buying a bigger home and we have a lot more room for Gia and our growing family, which is really exciting. And I also don't feel like a bad landlord anymore because I will never force our tenants to move out with only a moment's notice. But yeah, it was just a really horrible situation and I really wish they gave us a better option. So in my opinion, that's where I think buying wins, because just that stability of owning your own home and having somewhere to live long term, it's just a really nice feeling, like knowing that no one's going to kick you out. So yeah, that's why, in my opinion, buying definitely wins. And I also feel like in Australia, we need more laws for renters. I don't think it's fair for the real estate agent to just send us an eviction notice just because we don't want to sign up to another 12-month lease. I mean, what do you think about that situation? I just think that it's like pretty crazy. Anyway, thank you so much for watching this video all the way through. Your secret word is rent or buy, depending on which one you prefer. Let me know down in the comments below. Thank you. Bye.